Greetings. My name is Don Wago Moore Sr., and I'll be presenting financial trend and ratio analysis for Novo Nordisk versus Eli Lilly. This presentation evaluates the financial trends and ratio performance of Novo Nordisk and Eli Lilly over recent reporting periods. I will assess revenue growth, profitability, liquidity, leverage, and return on equity using DuPont decomposition. Based on these findings, I will determine which company demonstrates stronger long-term financial viability. Both companies demonstrate strong revenue expansion, driven by high demand, diabetes, and obesity treatments. Eli Lilly shows faster recent acceleration, indicating aggressive market capture and operational scaling. Novo Nordisk displays steadier multi-year growth, suggesting controlled expansion and lower volatility risk. Net income trends confirm profitability strength for both firms, confirming profitability and strength. The key difference is growth momentum versus stability. Asset bases, both companies are expanding, reflecting manufacturing and research investments. Novo Nordisk relies more heavily on retaining earnings, which signals internal financial strength and lower reliance on debt. Eli Lilly shows slightly higher leverage, indicating confidence in continued growth, but also introducing modest financial risk. Capital structure differences directly influence long-term resilience during economic downturns. Profitability ratios reveal that Novo Nordisk maintains higher gross margins, demonstrating superior pricing power and cost efficiency. Eli Lilly's net margins are improving rapidly, showing strong operating leverage. Return on equity is high for both companies. However, ROE, return on investments, alone does not explain its source. To evaluate sustainability, we must break return on investment into its components using DuPont analysis. Using DuPont decomposition, return on investment is separated into profit margin, asset turnover, and financial leverage. Novo Nordisk return on investment is driven primarily by strong profit margins and moderate leverage, indicating operational strength. Eli Lilly's high return on investment results from improving margins combined with higher financial leverage. While this boosts returns, it introduces slightly more financial risk. Therefore, the structure of return on investment differs between the two companies. Liquidity ratios indicate both firms can meet short-term obligations comfortably. Debt-to-equity analysis shows Novo Nordisk carries less leverage, reducing financial risk exposure. Eli Lilly's leverage remains manageable with strong interest coverage, suggesting controlled expansion rather than excessive borrowing. Long-term sustainability depends on maintaining pricing power, pipeline strength, and operational efficiency. My recommendation is based on three decisive metrics: revenue growth acceleration, return on equity drivers, and debt risk levels. Eli Lilly demonstrates stronger growth momentum and higher return on investment driven by operational scaling, although Novo Nordisk presents slightly lower financial risk. Eli Lilly offers greater long-term growth potential. Therefore, a growth-oriented long-term commitment, Eli Lilly, is recommended. This concludes my brief. I go into, I now, um, I will now give you an opportunity to ask questions and provide any answers that are needed.